Welcome to Knowledge Bank, where we delve into the world's most fascinating and enlightening topics. Today, we're counting down the top 10 financial mistakes in history. We've compiled a list of monumental monetary mishaps, from infamous market crashes to lesser-known blunders. We'll dissect the greed, mismanagement, and flawed thinking that led to each disaster and draw lessons from these costly errors. So, buckle up as we dive into the costly world of financial missteps, starting with the infamous Dutch tulip mania. Let us travel back to the 17th century Netherlands, where a flower almost bankrupted a nation. It was the height of the Dutch Golden Age, and the tulip, a recently introduced flower from the Ottoman Empire, had become a status symbol. The flower's unique and vibrant colors ignited a frenzy amongst the Dutch, leading to what we now know as tulip mania. Prices skyrocketed as speculators entered the market, hoping to turn a quick profit. At the peak of the mania, some tulip bulbs were selling for more than 10 times the annual income of a skilled craftsman. But like all bubbles, it eventually burst. In February of 1637, prices collapsed almost overnight. Many investors were left in financial ruin, while others were saved simply because they had diversified their investments. The tulip mania teaches us the importance of diversification and not getting carried away with a single investment. The lesson here? Don't put all your eggs, or in this case tulips, in one basket. Next, we head to 1929 for an event that shook the world, the Wall Street crash. In the roaring 20s, the American economy was booming. Stock prices soared, and everyone from the elite to the ordinary working class was caught up in a speculative frenzy, but all that glittered was not gold. Underneath the surface, the economy was unstable, riddled with overproduction, low wages, and a widening wealth gap. Then in October 1929, the bubble burst. Stocks plummeted, wiping out fortunes overnight. Panic ensued, banks collapsed, and the Great Depression followed, a decade-long period of economic hardship and unemployment. But what caused this crash? Overspeculation, investors borrowing money to buy more stocks, creating an artificial demand, inflating prices beyond their real worth. And when the reality hit, the fall was catastrophic. The Wall Street crash reminds us of the perils of overspeculation and the importance of risk management. While some financial disasters are well known, others are just as catastrophic but less publicized. Let's dive into some of the lesser-known blunders that have rocked the financial world. Take, for instance, the Enron scandal. This American energy giant was once valued at $70 billion. However, in 2001, it was revealed that Enron had been hiding debt and inflating profits. This led to one of the most infamous bankruptcies in corporate history, wiping out thousands of jobs and billions in investments overnight. The Enron scandal was a shocking reminder of the consequences of mismanagement and deceit. Investors were left in the dark due to the company's complex and misleading financial statements. The scandal highlighted the importance of transparency and accountability in corporate finance. Moving on, let's look at another lesser-known financial blunder, the dot-com bubble burst. In the late 90s, investors were caught up in the hype of the internet age. Startups with no profits or even viable business models were valued at astronomical levels. The bubble eventually burst around the year 2000, leading to a massive market crash. Investors learned the hard way that not all that glitters is gold. The dot-com bubble served as a stark reminder of the dangers of speculative investing. It underlined the importance of investing in businesses with solid fundamentals, rather than jumping on the latest trend. Lastly, let's talk about the subprime mortgage crisis. This blunder led to the global financial crisis in 2008. Banks and other lenders, driven by greed, gave loans to people who couldn't afford them. When these borrowers defaulted, it triggered a chain reaction that nearly brought down the global financial system. The subprime mortgage crisis underscored the dangers of reckless lending and the domino effect it can have on the global economy. It showed how important it is for lenders to carry out due diligence and for borrowers to understand their financial commitments. These lesser-known blunders highlight the importance of due diligence and long-term investing. From Enron to the dot-com bubble and the subprime mortgage crisis, these financial fiascos serve as powerful lessons. They remind us that greed, mismanagement, and short-term thinking can lead to disaster. But with due diligence, transparency, and a focus on long-term investing, we can navigate the financial world more wisely. These financial disasters, while devastating, offer valuable lessons. Let's dive into the wisdom hidden within these monumental mishaps. First up, the Dutch tulip mania. What can we learn from this? Well, it's all about the dangers of speculation. When prices are driven by nothing more than the expectation that they'll keep rising, you're on shaky ground. A smart investor knows to look for intrinsic value, not just potential for profit. Moving on to the Wall Street crash of 1929. This disaster taught us the importance of diversification. Don't put all your eggs, or in this case, stocks, in one basket. By spreading your investments across various sectors, you can limit your exposure to any single economic downturn. Next, we have the lesser-known blunders, such as the Enron scandal and the dot-com bubble. These examples underscore the importance of due diligence. Trust, but verify. Don't just take a company's word for it. Scrutinize their financial statements, understand their business model, and be aware of the market they operate in. Perhaps the most essential lesson from these financial fiascos is the importance of risk management. Greed can often cloud our judgment, leading us to take on more risk than we can handle. Always be aware of your risk tolerance and adjust your investment strategy accordingly. Lastly, let's not forget the value of long-term investing. In the world of finance, patience truly is a virtue. Short-term fluctuations in the market can be unnerving, but remember, investing is a marathon, not a sprint. By incorporating these lessons into your financial strategy, you're not just learning from history, but you're also setting yourself up for a more secure financial future. It's about making informed decisions, managing risk, and staying committed to your financial goals no matter what the market throws at you. So while these financial disasters were indeed catastrophic, they've provided us with invaluable insights. Insights that can help us navigate the often turbulent waters of the financial world. Remember, the smart investor learns from the past to avoid repeating the same mistakes. Investing is not just about individual decisions, but understanding the cyclical nature of financial markets and human behavior. The history of financial markets reveals a pattern, a cyclical dance of boom and bust, prosperity and recession. This rhythm, intertwined with human behavior, plays out over and over again, from the Dutch tulip mania to the Wall Street crash, the dot-com bubble and beyond. These patterns are largely driven by human emotions, fear, greed, and the herd mentality. When markets are booming, investors often get swept up in the euphoria, throwing caution to the wind. Then, when markets start to stumble, panic sets in, and the same investors scramble to sell, often at a loss. This roller coaster of emotions can lead to financial disasters, but savvy investors understand these patterns and use them to their advantage. They stay calm during market fluctuations, avoid emotional decision-making, and keep their eyes on the long-term horizon. They understand that market downturns are often the best times to invest, because that's when assets are usually undervalued. To stay informed and make smart decisions, it's crucial to keep learning and stay updated with market trends. Read widely, from financial news to analyses and expert opinions. Use reliable resources to understand market dynamics and economic indicators. And always remember, investing is not a sprint, it's a marathon. Another key strategy is diversification, spreading your investments across different asset classes to manage risk. No one can predict market movements with perfect accuracy, so it's wise to hedge your bets. Diversifying your portfolio can help protect you from the volatility of the market and increase your chances of achieving your financial goals. So as we navigate the complex world of investing, let's remember the lessons from history's biggest financial blunders. Let's learn from the past, but also keep an eye on the future. Because as much as markets can crash and burn, they also have an incredible ability to recover and grow. Despite these financial disasters, the economy always bounces back, providing opportunities for savvy investors. Just remember, every downturn is a potential upturn in disguise. So keep calm, stay informed, and invest wisely. From tulips to tech stocks, history is littered with financial mistakes that cost billions. But the silver lining is that with every financial fiasco, there's a valuable lesson to be learned. We've journeyed through time, from the Dutch tulip mania to the Wall Street crash of 1929, uncovering the root causes of these monumental blunders. And the lessons are clear. Diversification, risk management, and long-term investing are key to financial success. Beyond the well-known catastrophes, We also explored lesser-known financial fumbles like the Enron scandal and the dot-com bubble burst. The greed, mismanagement, and flawed thinking behind these disasters serve as stark reminders of the importance of responsible financial planning and avoiding emotional decision-making. And let's not forget the overarching theme of our journey, the cyclical nature of financial markets and the recurring patterns in human behavior. No matter the century or the circumstance, staying calm and informed during market fluctuations is fundamental to weathering financial storms. So, as we wrap up our historical voyage, remember, every flop is a teachable moment, and every financial mistake in history can be a stepping stone to your own financial wisdom. Remember to subscribe to Knowledge Bank for more financial wisdom and historical insights. We look forward to hearing your own financial experiences in the comments. Until next time, stay smart, stay informed, and stay financially savvy.